having some issues, maybe not with this platform, but with my slides freezing up. So if that happens, I hope it doesn't. Um, I all I have to do typically is stop sharing and then go back into it. But so let's jump right in. I appreciate this opportunity to speak with you folks today. I'm not sure how many of you. What was it, Spencer? A couple of weeks ago, we did a session, and so some of you may have been on that session where I did an overview of our simplified issue product portfolio. And then today, Spencer asked me to dive a little bit deeper into our Index Universal Life product, our Index Universal Life Express product, which is our IUL product as part of our simplified issue product portfolio. So that's the goal for today, and we'll just jump right in. Oh, let me back up. So when you hear when you hear the term express, that's our jargon at Mutual of Omaha. It's really synonymous with simplified issue, and we'll touch on that in terms of what that means from an underwriting perspective. Again, I always like to start with a little bit of a level set as to who we are as a company. For those of you that might be new to us or newer to us, I want you to have great confidence in who we are as a company. This isn't meant to be a company commercial, but just make you, if you're, again, like I said, new or newer to Mutual of Omaha, doing business with us, I want you to know these things. As you know, it's a very competitive marketplace out there, and you're never going to have to explain who Mutual of Omaha is or make up any excuses as to what we're doing or anything like that. So our brand recognition, our stability is really an asset, not for us as a company, but for you as our distribution partners and agents that are out there representing our company and our product in the field. Very dedicated team. I'm just the tip of the iceberg. Our competitive simplified issue product portfolio, which we went over last time, and are going to be covering one of the products this morning, which is the IUL Express. Again, brand recognition is out there. It's an asset for you when talking with prospects and clients. For those of you that are old like me, I grew up watching Mutual of Omaha, Wild Kingdom, and a lot of your clients have as well. And we keep the brand and the name out there with our golf sponsorships and things like that. So, and again, you should have great confidence in who we are as a company in terms of our financial strength. You can see here very strong ratings across all three major rating agencies. And then we have all sorts of support. Again, myself just being the tip of the iceberg, if you will, in supporting you. And then our simplified issue product portfolio. Again, we're going to be, I gave sort of a 30,000 foot view of this entire portfolio during our last session for those of you that were there or were able to attend. And this just talks about the products in the portfolio. And again, for those of you that might be a little bit newer to us or perhaps newer to the life side of the business, simplified issue underwriting, just in a nutshell, is it's not guaranteed issue. There is some underwriting, but of course it's not full underwriting. So with simplified issue underwriting, you got no blood, no urine, no exam. So what that means is your clients get the coverage they need as quickly as possible, and that you get paid as quickly as possible for the hard work that you're doing out there in the field. We try to do everything we can, and for those of you that have done business with us on the life side, I hope you agree that we do everything that we can, and we're always striving to improve. But we do everything we can to make doing business with us as effortless and easy as possible. And we'll touch on some of that a little bit in terms of when you look at some of the more process related things as opposed to our e-application and quoting tools and things like that. So, and the other thing too, I obviously feel free to take notes, but I will, if I haven't already done so, Spencer, I don't think I have. I will send this slide deck, this PowerPoint presentation to Spencer, and then Spencer, if you'd like to send it out to all the attendees, then that's great as well. So let's jump in. Our Index Universal Life Express, which is an IUL product, Index Universal Life, with simplified issue underwriting. I do want you to know that we also have two other IUL products uh, as part of our fully underwritten portfolio. And those would be for larger cases. I'll touch on that. But you do know that we have a total of 3 IUL products out there available for you. And today we're going to look at the simplified issue product. This slide is really self-explanatory. It just talks to you kind of high level about some of the the issue ages and the face amounts available. What I always like to point out, and for those of you that might have sold our Term Life Express product, this should look familiar because it's identical to what you'd find on our Term Life Express, which is our simplified issue term product. And by that I mean, at the younger issue ages, you can offer your client up to $300,000 of coverage with simplified issue underwriting, which I think is a compelling story. We'll touch a little bit on this with respect to our indexing strategies. Of course, like I always say, there's more moving parts to an IUL product, including our IULE product. And sometimes people who are newer to the product or maybe haven't sold it at all are a little hesitant at first, understandably, because there's more to know. There's more moving parts. I always say, and I truly believe, more moving parts is not a bad thing. It's a good thing. More moving parts is not a bad thing. It's a good thing because it's those additional moving parts, if you will, that offer this product's flexibility and really make it such a dynamic product. And with the indexing strategies, all that's referring to is how we credit the different the 3 different interest crediting strategies we have. We'll get into a little bit more, but this is an indexed product, so it is a universal life. It's a cash value product. It's a universal life product. However, for those of you that might again be new to index products, instead of the cash values growing at a very modest, 3 or 4% or 3.5% rate, the performance of this product and the growth of the cash values is tied to in this case with our product, tied to the performance of the Standard & Poor's 500 index, the S&P 500 index. And so what you have there, and what is one of the many attractive features of this product, is you have that upside potential. You have that, or your clients has that higher, greater upside potential for cash value growth because it's tied to the performance, the growth, the interest being credited to the policy's cash values is tied to the performance of the Standard & Poor's 500. And I sometimes forget to mention this, and I don't know why, but this is equally as important. In addition to the upside potential that I just mentioned, tied to the performance of the S&P 500, there is also with this product a 0% floor. You may have heard the phrase "zero is the hero." So what that means is, as we know over time, the S&P 500, over the last 20 years or so, certainly 15 years or so, has been doing very well, but it will fluctuate, and sometimes it could even go negative. But that your clients will be protected by that because they have that 0% floor where they can't lose anything with that guaranteed 0% floor. So what you have here is high level overview of the simplified underwriting. Like I said, simplified underwriting is not full underwriting, but there are still some underwriting requirements. You can see here, they don't vary too much, but the requirements vary a little bit based on issue age and face amounts. One of the things I love about this product, and it's true on a lot of our products or some of our products in this portfolio, is not only do you, and you'll see here in a moment, not only do you have an incredibly competitively priced base product, IUL product, we also offer a product design and pricing philosophy is to also, in addition to that, offer a product that has a robust set of additional riders. And we have both no cost riders and cost riders. So this slide, of course, is talking about our no cost riders. And of course, what that means is these are available at 0 additional cost. They're automatically included, and they and they're not underwritten or anything. So you get them, the client gets them just automatically, and they all have their pluses. And but I would definitely tell you that the no cost riders are very much anchored by our living benefit riders. We'll touch on those in a little bit more detail coming up here. And the reason I say that is you're able to have so much more of a comprehensive discussion with your prospects and clients, because now you're not only talking about a death benefit, obviously, that the base product offers, you're talking about living benefits. And again, I'll get into a little bit more detail over the next few slides that are coming up here soon. And it just makes for such a more comprehensive conversation with your clients. And again, we'll look at those here in a minute. In addition to those riders, which are no cost automatically included, we have a selection of cost riders, which of course are available at an additional cost. You don't have to select any of them. You could select one of them, two of them, all of them. It's up to you. But again, if you look at that combination of cost riders and no cost riders, it really is a good story to tell. So if we look a little bit now more into some of the basics of our IUL product, IUL Express, first and foremost, it's a permanent life insurance product. I mean, that's probably obvious, but the reason I point that out is, term, there's nothing wrong with term. We sell a lot of term, and term is the appropriate product in many situations. However, terms like renting a home versus owning a home, here's something where, your client is going to have that permanent solution, life insurance solution. Talked already about the fact that it offers simplified issue underwriting and the benefits of that. Also talked about the very attractive feature of the cash value growth being tied to the performance of the S&P 500, and all the different things that you can do with that cash value, that your clients can do with that cash value moving forward, whether they want to use it for income, tax-free income. As you know, this product, like all cash value life insurance products, the cash values grow on a tax-deferred basis. And however, in addition to that, they can take money out tax-free via policy loans. So there are other vehicles out there that offer tax deferral, like say an annuity, but this not only offers tax deferred growth, but also tax-free income. So that's going to be a very important feature of this product, to discuss with your clients. The target market, a lot of this is kind of self-explanatory. Some of it is just, traditional life insurance, needs income replacement. You can use this, and I'll show you in a moment, as a great mortgage term alternative to using term insurance for mortgage protection. But again, look at clients that want a very affordable coverage. I'll show you some numbers on that in a moment. And this product can even be used as a final expense alternative, which is because it's so competitively priced. But again, it's primarily going to be those that are looking for or are attracted by the cash value growth potential, also wanting a permanent product. And I would also say that it's generally going to be more attractive to younger clients. Now, of course, that's a very subjective term, but unlike, say, a final expense policy, which tends to be more with older clientele, again, very subjective term, older, but a lot of people that start to understand what this product can do for them, younger people, and by younger, that could be 25, but I'm, 35, 40, something like that. Those folks are looking to take advantage of that duration they have to have those cash values grow. So I mentioned, using this product as a mortgage protection product alternative. And let me just pause for a moment. This product, our number one flagship product, the number one selling life insurance product we have at Mutual of Omaha is our final expense product, Living Promise, which I'm sure some of you are very familiar with. And we're not going to go into any detail on that product today, but our fastest growing product in terms of sales is this IUL Express product. So I get the question all the time, well, okay, I like this. Gosh, the person down the hall, or the agency, down the street, or I've heard this, they're selling just, so much of this. How are they doing it? Well, the answer is often it's how you position it. So let's take a look here. If this is just a basic slide, and I'm not going to read through it all again, you'll have copies of these slides, but a mortgage protection scenario where typically you use a term product. And what you can see, and this is, I'm not trying to beat up or be critical of term, because we sell a lot of it and it's appropriate in a lot of circumstances. But I would tell you, maybe next time you're in a term scenario, whether it be mortgage protection or any other situation, take a look. Let me help you. Let us help you. Take a look at the IUL Express, because it's got all of these. This is, obviously it's got the death benefit. It's got the living benefit riders. Both products have it. But look at all the additional things that you get with IUL Express. You get a permanent product again, up out to age 120. The cash values we've talked about, the upside potential, tied with the performance tied to the S&P 500. Talked about tax-free income. And although the product is very focused on non-guaranteed elements and cash value growth, we also build in what I think is a very meaningful guarantee here. Whereas even with all that upside potential and flexibility, the client has a minimum of 20 years, a guarantee of a minimum of 20 years, or to age 80. So again, next time you have a situation where you would maybe use, whether it's our term product or another company's term product, doesn't matter. Take a look at our IUL Express. I would say you can't look at any other company's IUL Express, because we are currently the only carrier that offers a simplified issue IUL, which is very surprising to me. I would think by now we'd have a couple other competitors out there, and I expect in the next year or two we will. But that's another value add for you folks, is that if you're representing us in this product, there's no other company out there that offers a simplified issue IUL product. So let's take a look. I always forget these have animation. Let's take a look, and maybe that's hard to see, but again, we'll have the slides. So what I wanted to do here is kind of put my money where my mouth is, or whatever that saying is, and take a look at some of the numbers behind this. Very simple, basic scenario. You got some different ages here, $100,000 face amount. But what I want you to look at is here's the information on the term product, the premium, of course, and the coverage period, and some of the return of premium details. But then look over here at the IULE. So what you've got here, and of course these numbers, and I don't know if you can see where my cursor is, but these numbers here in red in parentheses are negatives, meaning this is the premium savings or the premium advantage that you have, or your client has, with this IULE product versus TLE. So think about that for a minute. In addition to all of the flexibility and all of the dynamic features in this product, it's less expensive than term. And over here, let's not forget, and this is, again, not sure you can see my cursor, but this is at a cash value at a very conservative 2.75 rate. Again, conservative based on the performance of the S&P 500. But look at this too. You've got these cash values, just looking out at year 20 and year 30. And then based on those assumptions, this very conservative rate, the age the coverage goes to. Now I'm going to hit enter, and it's going to look like nothing changed, but something did change if you caught that. Now at a higher crediting rate, but still very modest, actually. If you think about the performance of the S&P 500, it could be much greater than this. But let's just look at this modest rate of 5.87. And now look what you got. Again, you still have that same premium savings. You have these cash values, and now coverage on a current basis goes all the way out to age 120. So again, and again, like any other thing, any other product in this business, if you haven't, and I'm sure some of you have sold this product, so thank you. But if you haven't, the best way to learn is to take a situation like this, where it would have been sort of automatically a term sale. Take a look at IULE. Now and jump in on a live case. We can help you with that. when I talked about I talked a little bit just generally about the living benefit riders. And so again, so they're living benefit riders for terminal, chronic, and critical illness. And you can see here on the slide the triggers, if you will, what some of the conditions are that would make the client benefit eligible. And so, again, I won't read through the slides, but you can see what they are. But again, this is amazing, right? Because you're not only talking with this product about the death benefit, and all I know, I sound a little bit like a broken record, but not just the death benefit and all the attractive dynamic features of this products and the riders and all that. Now you can have a conversation with your clients about living benefits. And these living benefits are paid out as acceleration of death benefit. Okay. And because we know life insurance death benefits are 100% income tax free, these benefits also are 100% income tax free because they are simply an acceleration of that death benefit. This one might be a little hard to see, but this is how those benefits are calculated. Really cool thing here. Remember, these are automatically included, these riders, these living benefit riders, and there's no cost for them. There is a nominal administration fee once exercised and some actuarial adjustments that we have to make because we're paying out that death benefit uh, uh, earlier than we expected. And so there's some adjustments, but there's really there's no real cost to these, to the riders. This is another rider too that is, again, sometimes I forget to talk about. I made sure to put the slide in here, which is this product also offers a guaranteed insurability rider. I'm sure most of you are familiar with that, but just in case, what this is in a nutshell, the takeaway I'd want you to have is this is a rider that locks in the client's future insurability. And what I mean by that is we know as we get older, it's possible you get sick, you possibly become uninsurable. What's great with this rider is it allows the client to increase the face amount without evidence of insurability. That's the key, right? Without new underwriting at these significant sort of life events, as you can see here as I move my cursor along. So these are kind of the triggers, but it allows the client to get additional coverage in the future, increase their coverage without any new underwriting. So again, another great feature. I mean, if you think about it, and I'm obviously a fan of the product, but so maybe I'm a little biased, but just pause for a moment and think about all the things. And I know I'm hitting you with a lot of information and perhaps going too fast. I hope not, but you think about all of the things that this product offers. The pricing competitiveness that I just showed to you, proved it to you, if you will, right? The cash value growth, the flexibility of the product, the living benefit riders. It's kind of like the Swiss Army knife of life insurance products. And so, again, if you haven't looked at it, I urge you to do so. We've got all sorts of, in addition to like a training, if you will, like we're having right now, or a session like we're having right now, we have great training videos. You can see here, if you're not yet contracted with us or set up with us, and you don't have access to our full producer website, which is Sales Professional Access, or SPA for short. You just go to this website right here, mutualofomaha.com/simple. And this is our simplified issue microsite. The cool thing about this, there's no login. So you get right in there. So if you're brand new to this is a place to go. All sorts of different things regarding client materials, training videos, client videos as well. We really our marketing team really does a great job of putting those things together for you, those training resources. Again, this is just a screenshot of some of the additional tools. Some of these are, going to be more for producer use, for your use. But then there's also client approved materials. And of course, these are all available on our website as well. Transitioning now just to some more process issues, some of the tools we have. I just mentioned this, which is our simplified issue underwriting site. Again, no login required. You just jump right in and you have so much good material, and not just on our Index Universal Life product, our entire simplified issue product portfolio. When it comes to running quotes, I'm sure those of you that have done business with us are familiar with our mobile quoting tool. All of our products from our simplified issue portfolio are available on that tool. Very easy to use. With the Index Universal Life, there's going to be scenarios where you're going to need to run it on another illustration platform, which some of you may be familiar with, which is WinFlex or WinFlex Web. That's not our platform, it's an outside vendor, but that would be what you would need to run some additional scenarios and a compliant illustration for the IUL product. Oh, here's a screenshot again. Most of you are probably familiar with this. I'm very low tech. Our mobile quoting tool is so easy. If I can use it, anybody can use it. Just kind of shows you some screenshots here. Put it on your phone, put it on your tablet, iPad, and you're ready to go. You can set different preferences. Again, I'm sure a lot of you have already done this. Very simple to use. And as I mentioned, again, there's more moving parts to the IUL product. There's more to know. There's more to explain. But again, a good thing, not a bad thing, in my opinion. And part of that is you'll need to run an illustration, and you'll want to run illustrations using WinFlex Web because it really highlights the flexibility of the product. And then this product, again, for those of you that have done business with us, this product is, of course, available, as you can see all the other ones, on our iGo eApp, which is our e-application, which offers automated underwriting and instant decision. So we try to make doing business as easy as possible. We still have paper applications available too. I think we always will, even though our eApp adoption is over 90%. I think we'll always have that because, if you're meeting with a client, I'm sure this has happened, and you're meeting with them in person at their home, what have you, there's no Wi-Fi, there's poor Wi-Fi, you'll want to have that paper application as well. The benefits of using the eApp are frankly very self-explanatory. You can use it 24/7. You never have to worry about something not being in good order. By definition, every submission is going to be in good order, and it just accelerates and streamlines the whole underwriting process. Okay, so what I want to do now is pause and take a big drink of water, and I'll throw it back over to you, Spencer, or to the whole group. And please let me know if you have any questions.
Is it possible for you to go back to the slide that was comparing this IUL to a term ROP plan and just talk a little bit more about the value of the IUL versus the term ROP?
Yeah, great question.
Because that's really where I'm going to see an easy sales angle. Is when someone's looking for a term plan, we discuss the value of an ROP, they seem interested, but then we have the ability to take it even one step further and say, hey, if that's interesting to you, let me show you this.
Yeah. And was that Spencer?
Yes, sir.
Okay, so I just must, I can't, all I can see is my slide, so I didn't know, I thought that was you. Yeah, great point, and great comment, Spencer. And so, and like I said, and you just said it another way, especially if you're new to this product, to IULE, your initial sales are going to come from using it as an alternative. So in this case, we're using it as an alternative to our TLE, is our Term Life Express product, happened to be our 30-year term product, with the ROP. The same story would be true without ROP, but we just happen to show with ROP return of premium here. So again, just your different issue ages here, face amount, real basic, 100,000. Remember, we can go up to 300,000 on both our Term Life Express and our IUL Express. And you can see the premium amounts. This is for the term, when the coverage ends. Remember, term, depending on what duration you choose, in this case, it's 30 year, but after that term period, whether it's 30 years or 10, 15, 20 years, the coverage is over, and that might be okay. That it may have done its job, if you will, the term coverage. But what's super compelling about the IULE product is it's a permanent product. You don't have to worry about what happens at the end of that term. But then jumping into it over here, you can see the premium for the IUL and the guarantee, okay, out to what age. And then here again, if you can see my cursor, you see that premium difference over time. And these red numbers in parentheses are the advantage, the pricing advantage that IULE gives you over TLE. And again, not trying to beat up on TLE. We sell a lot of it. It's appropriate in a lot of circumstances. But those are the premium savings. But it doesn't end there, right? Because we still, in addition to the cost savings, you have your client has the ability to have these cash values that grow and at a greater rate, or potentially at a greater rate than a traditional universal life policy, because it's an index product. And then here at this fairly modest rate of 5.87, you can see where coverage goes all the way out to age 120. So, again, it's all about how you position it. And there's all sorts of, I've been at point of sale. I've been in personal protection myself. And, don't forget, in addition to the numbers, like Spencer, like you teed it up, if they were already interested in term, however you want to do it. But I've heard people say, well, oh gosh, okay, well I'm glad you like that option, but let me tell you about this newer product, and what it offers. And that's the index product, and that's the living benefit riders and all of that. So I don't know if that helped, Spencer, but that's really one of the best ways to, if you've never sold one of these products, to sell it is to look at it as an alternative. Maybe yesterday you had a scenario where you didn't know about this product and it was a term sale, and that's fine. You got the coverage, satisfied a need for the client's got the coverage, great. But when you start looking at some of these advantages IULE has, you can understand why this product is our fastest growing product in terms of production. Does that help, Spencer?
Yep, it does. And Barbara, I see you got your hand raised there. Just give me 1 second, because I want to ask a follow-up question. Again, taking a look at this slide, David, essentially the column that set on the IULE side that says guaranteed to age all the way at the bottom 70. That means that premium is guaranteed to stay level all the way up to age 70. What happens to that premium after age 70?
Well, on a guaranteed, so what that is saying is, on a truly guaranteed basis, that's the age that the coverage would end. But remember, guarantee is based on guaranteed cost of insurance, no zero interest crediting rate. And so you need to know that. You need to look at the guarantee, but it's obviously likely. I mean, even at 5.87, look at where the coverage goes to all the way out to age 120. But a guarantee is a guarantee. Okay, but it's likely. Let's just look at this 35-year-old on a guaranteed basis. The coverage would go out to 55, but on what we call a current base, it goes to 120. Well, it's not going to be age. It's not going to go just to age 55, and it may not go to age 120. But it's likely, and we have all sorts of spreadsheets that show this in terms of probability, it's likely that coverage will go to 110 or 115 or even 95, well in excess of this age here. So what you're really looking at is a difference between a true guarantee and what is potentially more likely on a current basis. Does that help?
I apologize. You're losing me a little bit on that. So essentially, if they buy the IULE product and they're 35 years old, they're going to be guaranteed to be covered up to age 55, right? That's what you're saying.
Remember when let's see, let me go back to.
So essentially it's still a term of a maximum of 20 years, but I think I'm getting confused is you're saying that the coverage then also goes all the way up to age 120.
Yeah, I was looking for another slide. Remember when I said, so it also, this product is primarily going to be attractive to and focused on those that aren't necessarily looking for guarantees, although there are some guarantees, more on the potential of the product. So here's I found the slide. So if you look again, if you can see my cursor. So you look at this guaranteed protection. So it's guaranteed, for the duration of the term. And then if you look over here under IUL Express, remember I said that even on top of all of the flexible dynamic nature of the product and all the upside potential that are non-guaranteed elements, we also have what I would say is a very meaningful built-in guarantee of, like you can see here, which it says a minimum of 20 years or to age 80. If that minimum premium is paid, which is something that's indicated on the illustration. So when you see this here, that minimum of 20 years or to age 80, that is what this is talking about. Does that help?
Okay, so essentially they're being guaranteed 20 years worth of coverage as long as they make their minimum payment.
Correct.
How is there a scenario where they would get more than 20 years worth of coverage?
Well, that would go to the performance of the policy. So let me back up. So let's say backspace. So here, let's look at these two scenarios again on this far right-hand corner. Here at 2.75, which is very modest. Here's where the policy, based on that crediting rate. So to answer your question, how do you get beyond that? Well, this is where the guarantee takes you for the different ages, right? Different issue ages, and this is where you would get to. But here's on a current non-guaranteed basis where the coverage duration would be. And this is at 2.75%, very modest. But, this isn't going out to age 120 or anything at this, or 100 even. But look at how much longer the coverage is or lasts, the duration of the coverage at a very modest rate of 2.75. Over here, again, this is a true guarantee. That's what we offer with that built-in guarantee. But even at this modest rate, look at your ages of, the duration of the coverage. And I'm going to hit enter. And you might have noticed this now changed to, again, I would say, at least based on the S&P 500, a very modest rate of 5.87. Look what happens here. In each one of these scenarios, they go all the way out to age 120. So that, again, the guarantee is what the guarantee is, but this product is going to, so that's nice to have. That's a nice to have, right? But the person that is, I think the thing to sell, if you will, or promote is, okay, we've got this built-in 20-year guarantee or to age 80, whichever comes first. But you can imagine, and I just showed two different crediting rates, but again, here at 5.87, I mean, you're getting, 20, 30, 40 years more coverage, even at this modest rate on a current basis, when you see this going all the way out to age 120. Does that make sense?
Because of the cash value.
Because of the cash value. Exactly. Yep.
Understand that, Spence?
Yeah, I think where I'm still grasping at straws here is, will the face amount of $100,000 still be payable if the person passes away after age 40?
Correct. Yes. Absolutely. So now if, okay, so one of the things that's, about this product, it's not as simple as a term product or a whole life product where you have a set premium, scheduled premium, you pay it or you lose coverage, right? This is a flexible premium adjustable life contract. Clients can stop and start premium payments. They can pay more, they can pay less. So if you wanted to look at different scenarios, that's where, and we can help you with this, that's where you want to get comfortable with the product. You'd want to see what happens under different assumptions to the coverage amount. But, if you're looking, at, again, I don't know which one you were talking about. You look at this 20-year-old, for example. Yeah, on a truly guaranteed basis, it's going to, the built-in guarantee will take it to 40. But the discussion you need to have, I'll hit backspace again. It's it's going to do better than that, right? Can I say it's guaranteed to do what the numbers you see here at 2.75 or when I hit enter at 5.87? No, I can't say those are guaranteed because they're not guaranteed. But that's true of any universal life product. But if you look at it, it's extremely likely that not only, yes, on a guaranteed basis in this scenario here, age 20 goes 20 years to age 40. Okay, that's the built-in guarantee if they pay that minimum premium. So that's it. There's nothing really more to say about that. That's a plus. That's a nice to have. But the person that's really going to be interested in this product is the person that wants, okay, that's great. I got that 20-year guarantee, but I want this product to last a lot longer. And you can see here, because of the cash values, how long it lasts.
I have a question. So is the only way that it would not extend is the only way it wouldn't extend beyond age 40 is if the value was at that 0.00?
Yeah, I mean, correct. So the only way, because let's say, so use the 20-year-old as an example, at that point, the coverage has been in force for 20 years. So there's going to be cash values in that policy. It would depend. Now, if they weren't paying sufficient amount of premium, could there be a scenario, or they took out loans sometime during that 20-year period between age 20 and the end of the guaranteed period, which is age 40? There still has to be sufficient cash value in the policy, but if they're paying their premiums, that's not going to be a problem. So coverage, again, this is just the built-in guarantee. Coverage will very likely last well beyond that. And that's what these two, and I'll back up again. That's why we show this again at such a modest rate. What does that do to the coverage duration? Look at here, you see. And then if you go to a higher but still modest compared to the performance of the S&P 500, this is what happens. And I would say, if you want, one of the best ways to get comfortable with the product is to start running just some sample cases, some illustrations, or let us help you with that initially. And you can see, obviously working on a lot of cases is the best way to learn it. But to understand all the flexibility of the product, we can run, we can help you run some sample illustrations.
I have a question.
Yeah.
For the IULE, when they hit the guaranteed age, does the premium, that minimum premium, stay the same, or does that go up?
So the minimum premium would stay the same, but that the minimum premium really only relates to the guaranteed premium, or I'm sorry, the guaranteed duration. Mm-hmm. So that minimum premium would still be there, but they're past the guarantee, so they don't need to pay that anymore. It's very likely they're paying more than the minimum premium. Again, that's one of the, I don't want to say complexities, but that's one of the things to know about the product. Mm-hmm. Is that the premiums aren't scheduled. You have to pay something, obviously, and it has to be appropriate to keep the coverage in force. And as it relates to the 20-year guarantee, you have to pay that minimum premium. But after the guaranteed period, the minimum premium is still the minimum premium, but you no longer have that guarantee. In most cases, yeah. So in most cases, when you look at, they'll actually be paying more than a minimum premium anyways. And so what you've got is a situation where that cash value is building. And that's why a gentleman, I didn't see the name, spoke up a few minutes ago. That's one of the really attractive features of this, is because when that cash value builds over time, yes, you can use it for for income, supplemental income, tax deferred growth, tax-free income, but very likely it's often also used as, you've got enough cash in the policy or the client has enough cash in the policy to pay the underlying charges, to pay the mortality charges, the cost of insurance charges. And so that's why with a product like this, if the performance has been sufficient, people can stop paying premium payments. You can't do that You can't do that with a term product, as you know.
Okay. And
Yeah.
last question, what's the cap on the interest rate that's paid from the investment portion from the S&P index?
Yeah, let me, very good question. I don't know if I've got another, I don't know why. So yeah, actually bear with me if you don't mind. I've got another, let me stop sharing for a moment and then see if I can pull this other, we should add it to that slide. Oh shoot. Can you see my screen right now?
No.
Okay. Well, let me just tell you what it is, because we have a presentation, obviously, for our 2 fully underwritten IULs, and that information, it changes, but that information is on this slide. And I know you can't see it, but let me just tell you. Okay. So and I can send you the slide so you have it. So I'll just tell you what it is. So at the 100% participation, there's 3 indexing strategies. At the 100% participation indexing strategy, it's 10%, and at the that's the 100. The participation rate is 100%, of course, and then the cap is 10%. And then the higher participation, lower cap indexing strategy, which is the second, it's 140% participation and a 7% cap. And then we have that lower participation or no cap, which is the participation rate is 50%. And then of course there's no cap, so it's uncapped. I don't have those committed to memory because sometimes they can change. But those are all current as of January 1st, 2020, this year, 2022.
So the max is 10%.
Well, the max, it depends. So the max on the 100%,
100%.
it would be 10%, correct?
Correct.
But remember,
And the other,
go ahead.
the other participations are at lower percentages. So for instance, if you're participating beyond 100%, it drops down that max cap down to 7 and so on.
Yep. So
therefore your max is going to be 10% and 100% participation.
Well, yes and no, because the other thing too is that and I'm glad you brought up that point. It's not all or nothing. Often a client will be spread across all 3 of these indices. You don't have to be, but you can be. And so remember, the uncapped, although it's at a 50% participation rate, which makes sense because you can't have 100% or higher participation rate and no cap, your company would go out of business, right? But so because you can blend these and utilize, or your client can utilize all 3 different indexing strategies, it kind of depends, because we have that uncapped option as well with the 50% participation.
So at less participation, you could exceed the 10%.
Correct. Yep.
Probably all things being relative to the scale, if you're at only 50% participation, though, it's probably, it'd be a tough measure there between the 2 of which one comes out ahead. Right.
But if you think, all good points, and these are some of the non-guaranteed elements, right? Because the biggest thing is it's important to know the caps and the participation rates, of course, right? But it's what's going to be the performance of the Standard & Poor's 500. Remember, a key is there's that 0% floor, so that's still there as well. That's very important, obviously, as a safety net, if you will. But if we talk about, with the 100% participation rate, the current cap being 10%, well, heck, I know I'm not sharing my screen, but we were looking at that one slide that showed, what the policy did in terms of performance at 2.87%. crediting rate, and then another one, what was it, 5.87 crediting rate, and at 5.87, it goes all the way out to age 120. So, you know, caps have to be there. All companies have them. I mean, they have to be there. But you know, at 5.87, if you remember back to that slide, it showed coverage lasting all the way out to age 120. So imagine what it looks like at 8, 9, 10%.
In all cases, it exceeded the return of premium. So it's like having the better of the both worlds. You're getting everything that you would normally get in a guarantee. You're getting everything you'd normally get in a return of premium.
Yep.
Except because of the cash value, you actually exceed beyond that. That's why you said earlier it could almost be used as a final expense, if you will, beyond the mortgage protection, because the cash value extends their normal life, which would otherwise have been a stationary term. You're actually getting perks, if you will, at no extra cost. In fact, it costs less. So it's a pretty attractive package.
Yeah, no, I couldn't have said it. I couldn't have said it better. Honestly, I'm not just saying that, and that's absolutely true. And I've got another presentation. It's a real quick one, but and maybe we could do it in a future session where I look at you mentioned, because I mentioned using this IULE product as a final expense alternative, and what I meant by that is really two things. One, if you're in a situation where you know it's a final expense sale, or you believe that that's the only need. You know, with our Living Promise product, the maximum amount of coverage available is $40,000, right? With our living benefit plan, which is 90% of the time more than adequate for a final expense sale. But what if you uncovered some additional needs and stuff there? Because then now this product allows you to go all the way out to $300,000. But another way of looking at it is how much more. It's not exactly, but you saw the pricing competitiveness of IULE versus TLE versus our term. The same holds true, I mean, roughly, right? The same holds true as to the pricing competitiveness of our IULE versus our Living Promise product, which is really saying something because, as you know, as most of you folks out there know, our Living Promise.
We're losing you, Dave.
Oh, I'm sorry. Can you hear me now?
Yep.
Okay, sorry. I started roaming around. I shouldn't do that. So our what was I saying? So it's really saying something that our IULE product is so competitively priced compared to Living Promise, our final expense product, because as you know, we're the market leader in final expense in large part, you know, in almost 100% of that reason is due to the pricing competitiveness of our Living Promise final expense product. So again, this product has, you know, those pricing advantages. We saw it with term in that scenario. It's got all the flexibility. It's got all those additional riders. Again, I think anchored most importantly by the living benefit riders. You know, you can talk to your clients not only just about, you know, if you're talking to somebody with term outside of the ROP, which is pretty amazing that we have a return of premium available on a simplified issue term product. But nevertheless, there's not a whole lot more to talk about with term. You can talk about so much more with this, with the IULE product. And so again,
yeah, because you have a living benefit at no extra cost for one thing.
Or lower cost, I think, as you pointed out. So it's
right, no extra cost. So that means with the savings, those add-on, you know, look, it came with plenty of riders already bundled at no extra cost, and still provided plenty of savings. So with that added savings, you can throw on some of those purchase riders and still be south of where you would elsewhere, leaving absolutely nothing unchecked.
Completely. It sounds like you've already sold this product, or if not, you're ready to sell it.
Well, what it is like you mentioned earlier, the live case scenario. So anytime someone like me has a live case scenario, you're looking for configuration statement. That's what I'm looking to do. For instance, I have someone now that's looking for a mortgage protection of up to $65,000 on that, and both of them needed a $10,000 each final expense. Well, because of all the flexibility of this, the pricing advantages, and that says nothing of all the added riders at no cost, by the way. geez, it looks like I could kind of bundle this whole thing. This product would replace all of them and do so at a savings.
At a savings. So, more features at a lower cost. I mean, whether it's a car or a motorcycle or a bike or in this case an insurance product, who wouldn't want that? More features, more flexibility at a lower cost. It's pretty
Precisely.
and that's why this product is going gangbusters. And
Is this new? A new product?
this product is only this product is less than 2 years old, about a year and a half. And
It's not brand new.
it's not brand new, and I can't believe it feels like we launched it just
Never heard of it.
ago, but it's been out there. And we got sales took off immediately, and now they continue to grow because of conversations like this, or because of situations where I heard such and such BGA or agency is selling, literally $50 million of premium of this product a year. How the heck are they doing it? Well, they're doing it with some of the realizations that you just mentioned, of how this product.
Sorry to interrupt. It looks like Raina has a question. She's had.
Oh, yeah, go ahead.
Thank you, Spencer. My question is, I have a 63-year-old. Would he be eligible to go the full 20 years to 83, or is he going to be capped at that 80?
The guarantee, good point. The guarantee would go out to age 80. In that scenario you just mentioned, the guarantee would go out to age 80.
All right. And someone with pancreatic cancer who hasn't had any issues, would fully underwritten be an option?
Yeah, that would be, something you'd want to take to fully underwritten. It's nearly impossible, if not 100% impossible for me to take a stab at that, but it depends on how long ago, follow up. Pancreatic cancer is a tough one, as we all know. But it would be a decline on our IULE. There's a possibility, again, depending on other factors and components, if you will, in the person's, follow-up care and all that kind of good stuff. It's possible with a fully underwritten product.
The fully underwritten IULE, or not at all? You said IULE is not an option.
It would be, no, but you
Okay.
could, yeah.
Something else. Okay, thank you.
Hey, David, to piggyback off that a little bit, if you wouldn't mind, can you speak to the underwriting similarities, differences between the IULE product, the TLE product, and the Living Promise product? I know you said they're all simplified issue. Can you speak to any differences or similarities that they might have?
Right. So the underwriting, good question. So the underwriting, this is one of the nice things about IULE and TLE. The underwriting is identical. So it's the same, and I know I don't have the slides up there. You can't see the slides. It's the same underwriting parameters, same issue age, same face amounts available in the underwriting, the questions asked, et cetera, between IULE and TLE are identical. In general, because there's higher face amounts available, available on IUL and TLE. In general, the underwriting now on Living Promise is, the underwriting on IULE and TLE is going to be a little more stringent, if you will, than the underwriting for Living Promise. And that's in large part due to the fact that you're talking about a maximum amount of coverage on Living Promise of $40,000, which again is more than adequate in 99% of the final expense scenarios. But that's how I would characterize the underwriting between the three of those products.
Okay, thank you for that.
Yeah.
There's some questions there's some questions over in the call-in messages. Can you see those?
Let's see. Let's see if I can get back to.
Well, the one I had was regarding the state riders. Some of them are state specific. Any of these riders we saw today restricted in Florida, the state?
Not in Florida. Oh, good question. No, not in Florida, but I will say, and this will come as no surprise, I think, to most people, the living benefit riders that I talked about on both Term Life Express. Well, I mostly talked about them on IUL Express, but those identical riders are available on our TLE, our Term Life Express, but those riders are not available in the state of California. We're working on it. As you probably know, California is really tricky as it comes to product approval and rider approval. So we're hopeful, but it's not. So that's the only state where those living benefit riders would not be available in the state of California. Any other, let's see, I don't see, where would I look at those other questions?
Down at the bottom, you should have you got your icons to the far right corner.
Yeah.
You got one of them, there's a little text icon.
It says chat with everyone.
It's called the in-call messages. Nevertheless, I think we've covered them. I had some live case scenarios. Spencer was thanking you, and you just answered the one about the state.
Oh, okay. Yeah. I just opened that up. Yeah. Sorry. I'm not very familiar with the Google platform, but yeah, it looks like we got all those covered. So again, I will send this, these slides, this deck, this PowerPoint presentation out to Spencer, and I'm sure he'll be fine with, sending that out to everybody on the call. And I'm looking forward to help. I really appreciate your time. Sorry that we went a little bit over our allotted 1 hour, but no problem at all, because I think those were a lot of really good questions. So, but again, I really appreciate your time and look forward to sending you these slides.
Okay,
David, thank you very much. That was extremely informational. I know that everyone on this webinar is going to take a lot away from the information that you've shared. You mentioned something else about doing a presentation that compares final expense versus the IULE, which I know you touched on that. We really have a focus on final expense here in the hierarchy, so I think that information would be invaluable. I don't know if you have a PowerPoint presentation that you could send us over for that, or of course we can talk off the webinar about scheduling that as well. But certainly that will be something that will be very, very helpful for our team. So thank you so much for your time today. This was very, very helpful. Thank you, David. Great.
Yeah. Thank you, Spencer. And thank you everybody for your time. I appreciate it. Have a great rest of your day.
You as well. Thanks.
Okay, thank you.
Thank you.
Bye-bye.